So they can get your bank statements, they can get your phone records, they can get your Trade Me records, they can get the notes from your bank manager.
We are back in your life. Michael is away on holiday, so I'm joined by Matt Harris today. Knock, knock, Matt.
Who's there?
The IRD is coming for you. Today, we've got a scary case study for you with the IRD and what you can do to avoid. Matt, the IRD, terrifying.
Look, definitely they are. So I'm going to refer to them as Inland Revenue because that's the more modern acronym, IR. And when I worked at Inland Revenue, they loved acronyms and they still do. But for the average person, Inland Revenue is scary. And the reason being is really actually quite simple. New Zealand has a voluntary compliance-based system. So what that means is that every single person in New Zealand is expected to voluntarily comply with their tax laws and to get it right. And what the Inland Revenue used to employ when I was there was something called the compliance triangle. And it was exactly like a pyramid. And right at the top is the people who don't want to comply. And then below is the people that want to comply but don't know how, and then down it was like people who want to comply and do know how, etc. And they basically, Inland Revenue strategy was to apply pressure to the top of that pyramid and therefore force compliance. And it works because you read in the paper, Inland Revenue prosecutes so-and-so, or you hear about someone who got audited and had to pay a lot of tax, and that keeps the ordinary person filing the returns in line. So it works.
Yeah, because hypothetically, if nobody ever got prosecuted, people would become more and more laxed about it all, right?
Yeah, definitely. And also Inland Revenue are very clever with this. You don't often read about Inland Revenue losing cases, and there's a very good reason for that. They settle cases that are marginal or give up cases that they're not going to win. So that what ends up in court is very strategic in that they nearly always win in court. And so that keeps this whole compliance, voluntary compliance system alive. And I think I said in one of the other podcasts is the Commissioner of Inland Revenue is tasked with collecting the highest net revenue over time. So that doesn't mean they have to collect every bit of revenue. And that's where they will make decisions on who to take to task and who not to take to task, and they will do things under those same provisions. They can write off unpaid tax or make settlements for tax payments and things like that. So it's actually really interesting kind of system when you look at it. And also New Zealand has quite a simple tax system comparative to other countries. We have what's called a broad-based low-rate system, which is where everything's kind of taxed the same. Leaves very little room for structuring, very little room for additional deductions. And also, if you look at individual returns, super simple.
Well, one cool thing is obviously you've got from a accountant's perspective how to deal with the IRD, but you worked for the IRD as well.
Yep.
So that gives you a completely different perspective from a typical accountant.
Yep.
So what I want to do is talk about what the triggers are that kind of get the IRD to look into your situation, because theoretically you could have bad luck, but is it more common that something has happened? Like you're talking about the force of the triangle. Be aware of the triangle.
The compliance triangle. I'm not sure it's still a thing at Inland Revenue, because the other thing that Inland Revenue, like all government departments, did really well was continually change the way it worked, and even the words that it used to do things used to change titles. But I think the premise is still the same. They basically want to hammer the non-compliant person, make them comply, or make it look to the people who do want to comply that they're doing that, because that's really important, right? If I know that my neighbour's not paying tax and he's getting away with it, my view on paying tax becomes quite different.
For sure.
If I know that they're prosecuting the shit out of him, I go, well, good.
I don't want that.
Yeah, I don't want that.
I hear him crying from his bedroom.
Correct. And his wife left him. And
his kids don't like him, won't even look at him. So let's talk about those triggers so we can stay in the good books. What are they looking for?
So in the olden days, it used to be a little less by design than it is now. So let me give a little bit of history. So I've been gone from the Inland Revenue for 10 years now, which has gone quite quick, and I still remember those days with fondness. I really enjoyed my time at Inland Revenue. It was a very interesting place, and I worked with some really good people.
Rocked a tie every day?
I rocked a tie every single day, like up to here. Yeah, because that's the only thing I've got PTSD from. I can't wear a tie now. But it was a great place to work and really interesting. Maybe at the end of this podcast, I'll tell a little story about some of the things that happened there. But in the old days, we used to, GST refunds used to be a really good place to start to find audits. And what would happen is we'd go through the GST refunds and we'd pick up some of the bigger invoices, we'd then write to the taxpayer and ask for them to provide the details. And then you'd go and check those people to see if they've returned, or we'd look at like property transactions, bigger widget stuff, and used to like kind of get a trail of crumbs and lead to all sorts of different things. So that was the traditional way. So I would call that the bad luck approach. But then within that, there were definitely triggers. Lots of late filed returns or unfiled returns, lots of transactions of high risk property, lots of money movements, things like that. And then right down to like just bad luck. The media's picked up on something to do with your business or industry, and that's triggered inland revenue to have a look at your industry in totality and, pick you out and have a go. That's now changed significantly as far as I'm aware, even though I have been gone for a long time. I still know people there and understand where it was going when I left. So now data's become a bit more of a thing at Inland Revenue. So they have large tracts of data, and Inland Revenue went through a process called business transformation, where they basically transformed the way that the revenue system works. And I think they stopped short of getting FPOS transactions. But what people should be aware is that Inland Revenue have very, very wide powers of information collection. So they can get your bank statements, they can get your phone records, they can get your Trade Me records, they can get the notes from your bank manager, what you told your bank manager and or your real estate agent when you're going to sell a property. So property's always been a bit of a hot potato in New Zealand because we don't have a capital gains tax. Inland Revenue's always been very interested in trying to tax property transactions that were undertaken with a short-term view to profit. And because we have this intention-based regime pre-Brightline, but even with Brightline now we still have it, what you did and how you acted is really important. So I guess the first pro tip is be careful with what you put down on paper, because people can often be confused about what their true intention is, and they might go in and confuse and or want to look good in front of their bank manager or want to look good in front of the real estate agent, say something that's actually not true. So they might, I bought, I just want to make a quick buck, when that actually might be quite a different scenario why they bought it, and they're only selling because their wife wants to buy a bigger house or something like that. But because human nature gets in the way. So I think it's just being aware that what you do leaves a trail, and Inland Revenue can get access to that.
Yeah. What about big changes in profitability or big changes in expenses, big changes in GST numbers?
Yeah, definitely. So with the data sets that they use, outliers will get picked up, and then there's that whole are we going to audit the person with a 50,000 potential tax bill or the person with a 5,000? So they will pick out outliers, especially in GST returns and things like that. And things like asset purchases, for example, stick out like a sore thumb when you look at that kind of stuff. And then they do, back to the industry type of thing, they will, for example, cash at restaurants continues to be a big problem. And they will go and do whole runs of data sets on restaurants, and they will get data on what the gross profit and net profit margins of these businesses be, what the wage to turnover ratios will be, and all that stuff. And they will use actual data sets to determine whether they should be auditing someone.
I do wonder, you go past some malls or some strips of shops, and you're like there is nobody in here. And you're like, what the hell's going on?
Honestly, there's a few restaurants. So I like to walk around on the weekends and listen to an ebook and just look at properties and kind of just, pay attention to some things. And I'm not going to name any restaurants on this because I think that'd be unfair, and also we could be completely wrong. But you often, there's certain restaurants I walk past that are always completely empty, and you're right, a lot of those will be cash, but I think nowadays there's also Uber Eats that keeps some of them going as well. But the cash economy is something that Inland Revenue's always been really interested in, and it actually reminds me of a great little story about Bitcoin. Back before Bitcoin, or when Bitcoin was merging, we used to have these things called gold-backed currencies. Petkinex was one that I remember. And a gold-backed currency is basically a digital currency, but it's backed by a piece of gold in a vault or otherwise. And then, so a lot of people would set up these systems so that digital currency, basically digital gold currency, could be used around the world. And Inland Revenue was really interested in that because what a tax system does is that it tries to, it works on the premise that capital is mobile, people are immobile. The reality nowadays is both are mobile because people leave countries, but back then capital was quite mobile, and that a country should be able to track flows of money within their country because that's how an audit function works. And if I get your bank statement, I can't see anything in it, I can't audit you. And so these gold-backed currencies were quite a concern to the tax administration because you could potentially move money from here to here and there'd be no actual transfer, no Bitcoin required. And so we were doing a lot of work on that. And then along comes a single Bitcoin. And that was an even bigger problem for the revenue systems of the world because, as you know, Bitcoin's on the blockchain and virtually untraceable, though I think the reality nowadays is quite different because to buy Bitcoin, you have to go through an exchange. Those exchanges are nearly always domiciled in your country or at least have AML requirements. So the Wild West has not become the Wild West because back then there was no AML, no IRD numbers for property transactions. It was all a really interesting time. And this Bitcoin arrived and I remember going to we used to get together as investigation groups and talk about the latest things that were going on. And someone who'd been working on cases would present like the findings, and someone showed up with a Bitcoin, and they actually had a physical Bitcoin. So I don't know if you've ever seen one of those. It's basically a round gold coin, but it's not actual gold. And then it's got like the serial number or whatever the code is for the wallet on the back of it. And at that time, it was they were given a presentation because it had gone from like 10 cents to like $4 or something, and no one could figure out how, or they could figure it out, but no one really understood why you could have something of no particular value that was valuable.
I'm still asking that question, but continue.
Yeah, well, it was. I learned actually, and I still know to this day that they, the person who invented Bitcoin, basically to mint the system, because government currency is backed by the government. So they needed some way to mint the system. That's where mining comes from. And it gets incrementally harder to mine a coin as the system gets minted. So it's quite a clever system. And I think if you look at Bitcoin, it's just supply and demand and a store of value, and it's all pretty interesting. But I often wonder where that goddamn Bitcoin is.
Yeah, I was thinking it'd be cool in the office. You you frame it.
Yeah, I reckon it's still probably in Inland Revenue somewhere.
Yeah.
And either sitting in someone's desk or framed, or
you reckon $100,000 piece of art? It'd be pretty cool in here.
Yeah, one Bitcoin's worth nearly 200,000 New Zealand dollars now.
Yeah, you're right. It's about $200,000, so it's probably an expensive piece of art.
Yeah, and like my main regret is like, why don't I just buy some? And it just goes to show you can be at the right place at the right time and still not do anything.
So you've talked about some things from the IRD's perspective.
Yep.
What about when it comes to the average Kiwi making a mistake? What kind of mistakes are they making?
Yeah, so I've seen every type of mistake from really severe to like really mundane. But the thing about it is that if you're going to make a mistake in your taxes, you often don't know you're doing it. And I hazard there's plenty of people that have overpaid tax, filed their own returns, and just made a hash of it, and they'll never know. But some of the things that I've seen range from really simple to downright stupid. So, for example, one common mistake I see with people doing their own tax returns if they're property investors is that they will claim principal and interest as a deduction. So, interest is the cost associated to having a loan. That is a deductible expense all day. But a principal reduction is capital because it's reducing the loan.
Oh, no.
Yeah, and P&I mortgages are very, very common, and it's pretty common for people to do that. And so 1 year in isolation is not going to get you a big tax bill, 2 years, 3 years. But if you're a 4 or 5 year property investor, you're going to get a pretty big tax bill if that comes to light. GST also is something that I see that it gets done wrong a lot. And GST, when it comes to property, because property is such a big widget, always ends up with a big problem. So I've seen every iteration of GST mistakes, but one that is quite common is people buying GST registered people buying properties on a zero rated basis. So New Zealand has compulsory zero rating. CZR came in April 2011 from memory, and it came in for a very good reason. Like most laws and over time in tax come in because someone's figured out how to get money or exploit a loophole. And so if we look at the 0% depreciation on properties, it's a great example. People used to depreciate property 3%. As I said in previous episodes, depreciation's allowance for something reasonably expected to decline in value. Properties didn't. People used to claim 3% before ring fencing, get refunds, and they sell their properties, never recover the depreciation. One of the primary reasons depreciation's gone. LAQCs used to be an entity that were really widely used in New Zealand, but then people went through, some smart accountant figured out that he could put his clients' own homes in the LAQC and deduct it against their own income. And Larry said, nah, got rid of those. So these are good examples of like how the tax rules move to close gaps. So CZR is a really good one. So without getting too far into it, in New Zealand, when you file GST returns, you're usually on either a payments basis or an invoice basis. On a payments basis, you pay GST when you get paid. You claim it when you pay it. By far the most simplest. Invoice basis is the earlier of the two, so invoice or payment. And we used to get property transactions, and we'd get a payments basis vendor who'd be loosely associated to a invoice basis purchaser. They would sell the property to the invoice basis purchaser, who would take the invoice from them and claim the GST, but they would never pay. Then that one would sell it on, and this one would drop out. And just go around in circles. It's called carousel fraud. And GST used to leak out of the tax system like crazy. And one thing that it did working in Inland Revenue desensitizes you very, very much to like how much tax leakage and money wastage, and also how the system can be a little bit unfair, because that old example where they're going to go for the 50 grand guy over the 5 grand, sometimes you get extreme versions of that where it's too hard. They've actually avoided so much, and maybe they're offshore, or it's too convoluted that they go back to the 50 grand guy or the 5 grand guy because the 5 million one's too hard. So you get all ends of the spectrum. But so carousel fraud was a big thing. So zero rating came in. So what that means is if I'm a GST registered purchaser and I'm buying from a GST registered vendor, that GST liability simply passed through to me, so it stops all that nonsense. Why is this a problem? Well, it's a problem if I'm intending to on-sell that property. So one of the common reasons for being GST registered be property trading. When I can't claim GST on that purchase, but when I sell, I still have to pay GST. So 15% of the property value is gone. That's a pretty common mistake, and you go, oh, well, you should have got your accountant to check that. You should have done better. But where it gets worse is I've seen people be convinced by either the real estate agent or the vendor that they should register for GST. They've zero rated the property through to them, but they're a residential property investor, and residential property investments GST exempt. So they immediately have to deregister and pay all the GST back to the government. And I've seen that way too many times to count. And I've even seen it from like lawyers who've just, GST is something that's commonly mucked up. And so something, so
I wonder about the liability of that stuff.
Oh, yeah, you do. But also it's contractual, because what it comes down to is there's a contract between a willing seller and a willing purchaser. They've had every chance to check those contracts and amend the GST clauses, and they've taken the action. And so it'd be pretty hard to go back and prove that someone made you do it. Yeah, so that's something to be aware of. GST, if you're dealing with GST and property, make sure you talk to your accountant, because it goes wrong a lot.
What about like little things like, say for example, I'm coding transactions every day, and it's very easy. I make a mistake when I'm coding a transaction. If the IRD comes in and audits me and they go, hey, you've coded this, it should have been this. And I don't know, say over a period of time, I've made like $10,000 worth of mistakes, right? Do they just come in and go, you didn't do this right, you've got to correct this? Or is there like, is there a penalty?
Yeah, so that's a really good one. So Xero accounting software has revolutionized the way that accountants work. It's made it a lot easier for everyone. But the problem with the Xero system is that it's still a double entry bookkeeping system behind it. And if you don't know your debits and credits off the top of your head, you shouldn't be using a double entry book system.
I just click the buttons.
Yeah, I know. I check it. But bang on, we get that a lot. So when we get zeros at the end of the year, the accountants go through them and do general ledger reviews and general journal reviews, and they'll go pick stuff out. But common example, right? Someone might have bought an asset for business, and the payments will be coming in, and they'll code them to interest or motor vehicle expense when actually they're a reduction of the loan. So we get lots and lots of mistakes like that. Just so people know, it's relatively easy to deal with that kind of stuff. If we catch it at the year end, we just adjust it in the income tax returns and the financial statements, and no one knows. If Inland Revenue come in and catch it, the ordinary course of events is that they do what's called a risk review. They'll send a letter, and we just dealt with one for a client with regards to a property transaction. And we actually got a really good outcome for them. They were trying to tax a property transaction, and we went back through all the reasons why it happened and the reasons why it was bought and sold. And it was outside Byline, but it was still relatively quick transaction and added value, but it was due to changes in circumstance. We actually got them off that, and they didn't have to pay. So it was a really great win for us. But they send a risk review. And so the risk review says, these are the things we want to look at. And at that point, you get the opportunity to make a voluntary disclosure. Or in that case, we were like, no, this is not right. You shouldn't be paying tax on this. So we go back and respond to the risk review. But if you have done something wrong, voluntary disclosure, and what happens as a result of that is you get 100% reduction in a shortfall penalty, as long as it's non-taking reasonable care or unacceptable tax position. So I have to think about this. There's 4, I think, penalties for tax in New Zealand. Not taking reasonable care is 20%. And so that just basically goes, have you taken the care that a reasonable person would in these circumstances? If you have an accountant, you can't get not taking reasonable care because you've paid your accountant to take care. Unacceptable tax position is basically a similar test, but it's a threshold. You have to have over 50 grand of tax owing. And then outside of that, you get gross negligence and then evasion. And evasion is 150% of the tax shortfall. So if you get 100 grand of tax shortfall, you pay $150,000 penalty on it. So you're in serious shit if you get that one.
Yeah. Let's try and avoid those.
Yeah, we've had no clients get anywhere near that. But the point being, if you have made some errors, come and it's found out, there's no need to panic. The automatic theme is like, shit, Inland Revenue's getting me, which is a theme they want you to have. But the reality is much different. You get the opportunity to make the disclosure. Penalties will be reduced. Life will go on.
Yeah, awesome. Okay, well, what I want to do is talk about how to protect yourself, if the IRD does come knocking, or how to avoid them coming knocking. And we're going to do that after this break.
At Lighthouse, it's not about avoiding tax. It's just about paying the right amount of tax for your situation. We'll help you stay compliant, claim every deduction, and help keep the IRD off your back. Get in touch via the link below. Now back to the episode.
So Matt, I want to be able to sleep at night and know that the IRD is not coming for me. So what are some tips you can give me to avoid the IRD?
Yeah, I think the simplest thing to do to keep the IRD off your back is file your returns on time, pay your tax on time, because you give them no opportunity to look at your affairs in any way at all. There's no little alert popping up their system. They don't have to send you reminders. That's the first thing. And then I think the second part of it is being reasonable with what you do. I am a big proponent of paying the least amount of tax possible, but within the rules. And in my previous career at Inland Revenue, no one wins when you trying to dodge tax. Eventually it catches up to you. You can't sleep well at night, that kind of thing. So what you're trying to do is just ride that nice middle ground, take what's reasonable, but make sure you take the mindset that paying tax isn't a bad thing, and that it means you've got some sort of success in your life in terms of business or investments or otherwise. And I'll give you one example to end this, is that prior to the ring fencing of investment property losses, you used to be able to make a loss in a property rental and claim it against your own income, and you get a tax refund. And we used to call that intoxication. So that's the euphoria you feel when you get a tax refund until you realize it was your own money to begin with. And it was really funny. We used to get clients who maybe they got a $5,000 refund the year before, but then suddenly interest rates had come down and they got like $1,000 tax bill. And the complaints we would get about $1,000 tax bill versus a $5,000 loss was refund was unbelievable, because what they don't understand, and this is what you should understand as a taxpayer, is that if you make a loss, the max refund you could have got back then, you can't get them necessarily now. It depends. Some ways you can in business, but not in property. The max tax refund you could have got back then was 33 cents in every dollar. So you made 72 cents in every dollar as a loss. The max tax you paid back then was 33%. So you're 72 cents better off to make $1 of profit than you are to make $1 of loss. And it just always showed me there was a real lack of understanding when it comes to tax. If you are paying tax, you are in a fortunate position. You have made money.
100%. I see this all the time where like business owners and new business owners go like, oh, I'm going to keep my income at 100. Like they go to like a good business and they go, oh, my account told me to only pay myself $180,000. And I'm like, dog, at some point that profit's going to come out and you're going to pay tax. You might as well take it now, because as you said before, $1 today is worth more than $1 tomorrow. It's just misinformed, isn't it?
It's lack of financial literacy, which is something we come across a lot in our line of work.
Yeah. Can I ask you one more question? There's been a few cases recently around companies going under, and especially like GST and tax owed to the IRD. And there's this it's created a little bit of controversy in the media with a couple of them, where essentially they're going, I've got to pay my staff before I pay my tax.
Yes.
If you are in a position where, and obviously economy, don't know if you know this, Matt's been struggling a little bit.
I know.
What tips would you give to somebody who is really struggling and going like, I feel like I have to make that kind of choice?
Yeah, so I think first of all, make sure you talk to your advisors. There's options there. It's better to file the return and not pay the tax and go to Inland Revenue and put it under arrangement than it is to not file and not pay. And then it comes down to, without telling people what to do in this situation, because it's not a good situation, if you are in a position where you have employees, and you've got taxes, so we've got payroll taxes, and then you've got income tax and GST. Out of those three things, always pay your payroll taxes first, because that's treated the most seriously. And the reason being is those taxes don't belong to you. They don't belong to the government. They belong to the employee. So always pay your payroll taxes. If you've got any money to pay the tax, PAYE first.
Surely the liability still sits with the employee, because they're the one that...
Yeah, okay. It does, but it's basically those employees have earned that money, and it's a tax deduction that goes against their income.
Right, okay.
So Inland Revenue treat it very seriously.
I mean, with most, like, I see most businesses use some sort of payroll system, right? Yep. Like it'd be...
Well, if you assume that we use a smart payroll system, it's brilliant. Pays employees, pays Inland Revenue, there's no issues.
KiwiSaver's done.
Everything's done, but lots of businesses don't operate like that, and payroll taxes, if you look at a lot of the liquidations that we see, payroll taxes are probably one of the primary ones, and GST being the second. Yeah, so if you're having trouble with Inland Revenue, sticking your head in the sand is not an option. You have to front foot affairs with Inland Revenue. They are, we talked about the psyche of Inland Revenue. Of course, you're scared of them. No one likes that, but they're actually just people doing their job within a framework, and they're far more responsive if you get ahead of it and say, look, I've got trouble here, I'm trying to manage it, than they are if you just stick your head in the sand. Yeah,
for sure. Just like in all areas of life, right? If you kind of hide it, people get angry and annoyed. If you go, I'm in a bit of trouble here, I need some help, you're much more likely to get the help.
100%.
All right. Avoid the IRD at all costs, please. If you need any help, make sure to reach out to the team at Lighthouse Accounting. Michael, just remember, enjoy your holiday. This means nothing to me. Much love to Lighthouse for sponsoring this episode. Please subscribe to the YouTube channel. Give me a review. Give us a like, and we'll catch you next time.
See you later.